Earlier today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/4 to 1/2%.
Janet Yellen raises interest rates. Finally, we can start talking about it and stop speculating about it. John Authors, Gillian Tett. Guys, we were here in these exact same seats 3 months ago talking about the exact same thing. But the last time Janet Yellen didn't deliver, this time she did. Gillian, relatively benign market reaction today, it seems. Do we give Janet Yellen credit for having anticipated this so well and for having prepared everybody?
Well, thus far, I think we give Janet Yellen a round of applause for a very smooth liftoff thus far. You can call it a Christmas present, a holiday present for the markets, in the fact there hasn't been a violent reaction. The problem, though, is what comes next. Not just about where are rates heading in 2016, although that's a very big question indeed, but also, will the Fed actually be able to turn this pledge into actual increase in the price of money as measured by federal funds? Can it actually get its rather broken transmission mechanisms to work? Very geeky stuff, but the workings on the money market instruments right now, the reverse repos and all that, really, really matters. And then question 3, which is related to that, is what on earth does it do with its bloated, enormous balance sheet?
Okay, so we're going to talk about all those things. I want to talk about the future for sure, but John, first of all, was this the right call now? Should Janet Yellen have waited those extra 3 months, or does it not really matter?
Well, I think you could draw some analogy with 2013 and the taper tantrum that the Fed's prepared people for months on end, endured the taper tantrum, surprised people by not tapering in the September, and then when it finally did taper in December, managed to do so in relatively calm conditions. It appears we're weaning the market ever so gently off this remarkable monetary policy that we've had for so long. It appears that that's how long it takes to drag the market kicking and screaming to higher rates. I mean, the signal of this is plainly very important indeed. The fact that so many people were still arguing that it was a bad idea, including the FT leader column this morning, we should point out.
Some intra-FT squabbling going on
indeed,
there,
but there's plainly a perfectly respectable case for not doing this. So yes, that it has meaning, even though we are still at remarkably low interest rates, and we were very well prepared for it. It does mean something. The question is, it's just such a small step on such a long journey that has to be taken.
To which I would argue, by the way, that one of the reasons for the difference of views in the markets, in the policy-making community, and inside the FT, and we're proud to actually act as a platform for different views. One of the reasons the difference is whether you're looking at this in terms of macroeconomics or the financial markets. In purely economics perspective, you can argue, in fact, it may be not necessary to actually raise rates right now. But in terms of the financial markets perspective and trying to restore some of these levers, some of these transmission mechanisms, trying to get markets actually working correctly to price money in the way that policymakers think they should do, you needed to wean the markets off this addiction to a very bizarre world of zero rates.
Yeah, still kind of a point of contention also, the extent to which it's appropriate for the Fed to consider financial market stability in making decisions about its two mandates.
It doesn't have a choice, though, really, at this point, does it? I mean, if we've lived through 07 and 08, markets can create their own reality.
Completely, and also it's not just a question of financial market stability, it's about financial market functioning. Are these markets, these normal transmission mechanisms, actually working or not? Because a world of zero rates for a long time creates some very bizarre distortions and very bizarre effects. And the Fed, like many ordinary investors, is keen to go back to a world where the levers of the markets actually work.
Did anything surprise you guys, either about the statement or about the way Janet Yellen discussed it in the press conference, John?
I was slightly surprised that it wasn't even more dovish. And given that I was slightly surprised that it wasn't even more dovish, I was surprised that the market treated it as being as dovish as it did.
Can you explain that, though? When you say you expected it to be more dovish, what do you mean specifically?
There was the dot plots, which the famous graphic where every Fed's governor's estimate of where the Fed funds rate is going to be at the end of next year and the year after in the form of a dot, which has been out of line with the market and out of line with reality for a while, but in September it showed a median of estimate of 4 rate hikes next year. there was a lot of people expecting quite reasonably that part of the dovishness of this hike would be that would have come down to 3. It didn't. It stayed at 4.
Right. And the market is anticipating what?
The market is at this point anticipating only about a 60% shot of 2 rate hikes for the whole of next year. If we can believe the Fed funds futures market, it's barely even a 20% shot that we'll get 4 hikes. There is a huge gap still there. It's interesting. I didn't really catch anything that Janet said during the her conference that was that startlingly dovish, but during the conference, the S&P gained 1%. That strikes me as the market probably not hearing quite what she was trying to tell them.
She did kind of seem at pains to emphasize that this wasn't that big a deal, that monetary policy is still very accommodative. Gillian, are we headed for a reckoning between the market expectations of what rates are going to do and what the Fed is saying now, as John just mentioned?
I think there's certainly the potential for a reckoning, and she is trying to deliver a Goldilocks monetary policy that's not too hot, not too cold, just perfect. And she's trying not to spook the markets, but also to indicate that she feels that clearly there are economic reasons for pushing things higher in the medium to long term. I mean, the reality is that if we were to get a rate increase in the long term of, say, 100 basis points at some point rapidly, as these differences in market perceptions and the Fed's projections actually come into collision, that could be quite nasty for investors, because there's a terrific report out from the Office of Financial Research Stability Report earlier this week, pointing out that effectively the investment industry is positioned with such long duration in their own bond portfolios that any unexpected swings in rates could have a very nasty impact in terms of creating losses.
And the question now is it going to work? What do you think?
Well, right now the Fed is like the pilot of a plane where it's used to, say, pulling on the rudder and something happens and suddenly half of the actual transmission mechanism devices are broken. And they're worried that they will declare that they're going to do something and it won't actually be reflected by action in the markets. So they are going through some very pretty arcane, complex moves to try and make sure that their monetary policy actually works. But it's going to take several days to play out. And the reality is that if these rather complex moves don't actually work, if the Fed funds rate does not move as the Fed wants or have the impact on the price of money that the Fed wants, the credibility of the Fed could actually be quite badly undermined over the next week. And that's something that nobody wants to see.
John, final word to you.
I agree completely on that point. The Fed's credibility is very important. That's why they went through with the rate rise today. They felt it was necessary to prove that they could do it. They've proved that they're prepared to try to do it. Yes, we still have one last very important technical question to answer before we can all relax at least for a few days over the holiday season.
But should we think it's a big deal at all for the Fed to have a massive balance sheet while trying to control short rates? In other words, if it works, is it a broader problem for the Fed?
I mean, it's obviously a big deal that they've resorted to extremely unusual monetary policy for a long time. You could certainly argue that it's been a reasonable policy to take. You have to be extremely imaginative when you have the kind of exceptional circumstances that confronted them in 08 and 09. But we still have to see whether they can work out if they have the right tools to get out of it.
Okay. All eyes on the overnight repo rate.
Indeed. Okay. Gillian Tett, John Authors, we're out of time. Thanks to the both of you. And thanks for watching. Go to ft.com for all of the FT's comprehensive coverage of this big event of the first rate rise in about 9 years for the Fed.